Welcome to the Dividend Talk podcast, episode 172. All we know about bonds and should we own some? Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJI. It's been a busy week. I haven't heard much from you until today.
Oh, yes, that's totally right. It's high season at our company. I am just full with work. And yeah, we have the newsletter, right, as well. So this weekend we will publish our new issue again. So yeah, it just keeps me busy, It keeps me also off the street. My wife is happy. But generally, yeah, it's just the season. I don't know how it's with you at work. Do you have seasonality?
Yeah, of course we do. This time of year, well, usually we do day to day, but I'm in like capital projects as well, so that's depending on projects, and we
On
have
deadlines. Yeah.
yes, we have some big projects coming up and some big projects we're trying to close, so it's extra busy at the moment. But that's the nature of the beast. You go through times when you can sit back and relax, so you got to take the good with the bad. And look, another few weeks, we'll have a few weeks off to recover. It'll be Christmas time, and we can.
Yes. I hope you will come to Poland and visit me. We still haven't landed on this one yet, but you should come. You should come,
Yeah, I
and we
know.
can do another
We will
I said
definitely
gathering.
we will definitely make it not over Christmas, but probably January, I would say.
Yeah, that would be awesome. And then we ask our Polish listeners to join us in Warsaw for a beer
Yeah,
and just talk about dividends.
it'll definitely happen. So start maybe middle of February. We'll get it booked.
Awesome.
Okay, let's. I think we have a pretty packed show. We're going to talk about something that we haven't ever talked about on this show, which is bonds, and we'll get to that. Later. But we have quite some news. We might start with. There's three really good ones, but we might start with Germany. They are going all out to bring the brains back to Germany, aren't they? They're making some reforms, just to kind of keep the German industry taking over and stop US people emigrating to the US and taking all our European talent. What do you make of these reforms? It's more like tax and stock compensation.
I'm really happy with this to hear this for once. The only thing I hear, like, Dutch elections are going on now. The left wants to increase even more tax on everything that people work their ass off for. And so it's refreshing to hear a country to say that they want to turn a little bit ship. Yeah. Because I was actually talking with someone not too long ago, and I said, like, if there's one thing I really appreciate about Americans, is their tolerance for risk taking and their culture of allowing companies and people to fail. Yeah. And we don't have that really in Europe. And it so much helps when you have a government that understands a little bit what it takes to be competitive in the tech industry.
Yeah.
So in this case, it's about stock-based compensation, right? The startups, so that they only get taxed when they sell and not straight away. Also, capital gains tax rules will be changed. So startup employees are charged tax on the profits they make when they sell their shares. also they also view this tax really in the light of, most of those employees are young, taking a risk in an unproven startup. So it will really mean that also, for instance, I said for companies up to 1,000 employees, I believe, and up to $100 million or euros in revenues, that these benefits will exist. It also means that we can see that they will allow such things like Facebook as dual class shares, where class A, let's say, keeps the ownership, and class B is then more for the employees in general public. Yeah, and this is what we know, generally speaking, that if you want to have venture capital, that this is what they're looking at. So Germany is really trying to increase the attractiveness and to jump a little bit on the bandwagon of the tech industry. Let's say it's never too late.
Oh,
I don't have a lot of faith in the German economy from that point of view, because I don't know, if you look at labor laws and everything, nothing seems to move. It's I mean, it's not about bashing German industry, because you see it in almost every European country, right? There's nothing special there. But if you look at the car industry and everything, and yeah, that doesn't give me a lot of good mood, let's say, like that. So then seeing this news really caught my attention. I thought really like, whoa, we have politicians understanding it and actually getting to pass legislation in this. This is a big thing, I thought.
it's huge, and even from a broader sense, a European sense, it could be also huge, because you would imagine there might be a couple of countries. I'm thinking of the UK and France, probably two of the big ones, that might sit back for 12, 18 months and see how this goes. And we might see them mimicking what they're doing, which will obviously be pretty good for Europe. I mean, I don't see much risk on the behalf of German here in Germany.
No,
I mean, they might lose a few dollars in tax here and there, but I
they
think
can only win out of this. Yeah.
exactly they can only win. And I really like the one where they don't have to pay tax from startups, because that's really going to encourage people.
Yeah.
New ideas, let's go. And there'll be a lot of failures along the way, but they only need one or two to be really successful, like the next Amazon, and it'll pay for itself. But I think, look,
Yeah.
as European, I'm happy there's a European company finally standing up to do this. And I think Germany's got a bit of a shock in the last while, particularly because their economy is so poor. They're under
Yeah.
pressure from the US. Then there's tensions with China. All this is kind of
Yeah.
coming to a head, and they finally decided to say, okay, let's be Europe again, or let's be Germany again, and let's start pulling back some power. So
Yeah, and they have some pretty smart cookies there. I mean, SAP exists. It's still a
yeah,
powerhouse, right?
yeah, of
And tech
course, yeah,
industry, and there are a few other tech companies that are really well known. But what I said, the risk taking. That's kind of what I'm not really seeing a lot.
yeah,
Maybe it's also not so visible to us. But also, if you look at the companies that really get out of it, you can count them on one hand. Yeah, and I think this is what they really want to improve and need to improve,
yeah,
because America's really dominant in the tech industry, and we need strong companies in Europe. Like it's a blessing that we have ASML and Adyen, the payment processor, as an example as well. We need many more of those companies. And why can't there be a social media giant originating from Europe? Why does
yeah.
it need to come from America? Can we really not invent the next Facebook or Instagram over here?
Yeah, exactly, exactly. Look, I think it's positive all around, and I think it's a good intro actually into the next topic on the news, which is Siemens, a German powerhouse, I have to say. And I am kicking myself with these guys. I remember they were under €100 for a time. We said it, buy them at under 100, buy them under 100, and I just did not buy anywhere near enough. 2023, they released their quarter four earnings, and then their annual report will follow shortly afterwards. But you have to say it's been quite the year for Siemens. Record breaking revenue, rose 7% to 92 billion. Their net income doubled year over year, to a record high. Their free cash flow is now standing at around 10 billion, and they raised their dividend to €4.70, and that's up from 4.25. It's been a blockbuster year from them. The only kind of I would say, I say blot, but the only kind of negative thing that I seen in the report was their digital industries. Um, their revenue kind of stayed flat, but you can see their order started to decrease as some companies tried to destock. Because when we had some issues with supply chains, a lot of companies bought in advance and now they don't
Yeah,
need to buy as much. So you can see some orders kind of flattening out a bit. But what a year from them. We're talking about German companies and German powerhouses. This was an incredible year from them. And they're
yeah,
so well diversified across a range of spectrums that I believe are future proof.
yeah,
I think it's just an incredible company, and I'm honestly kicking myself I did not buy more at 100. I should have just loaded up the truck
yeah.
and bought into them.
There was also quite some controversy around this because they spun off energy, Siemens Energy, right? And
Yeah,
then Siemens Energy got, let's say, supported by the government.
yeah,
So that feels to some people I notice also on social media like, well, there was a bailout, and how dare you, Siemens, and raise the dividend. But yeah, those are technically now two different companies, and this
yeah,
is not the nice side of capitalism. I kind of agree with that. But look, I've been so often on the other side that I'm actually, for once, like, you know, being cheering for myself, like, oh God, luckily they sold it on time. Usually it is too late, right? And
yeah,
I get the stinky cat in the bag.
yeah.
So
Is that good management? Is it lucky? Is it a bit of both? There's definitely some insider knowledge there. Definitely, I would.
yeah, I can't speculate on that. I have no clue. I know too little of the case. I'm just happy that it didn't hit me in my account as such. So I'm just happy with Siemens. Like you said, it's a powerhouse, one of those German companies that I'm really proud on having in my portfolio, together with, for instance, Munich RE.
Yeah,
Siemens and Munich RE are some shining stars in my portfolio, both from Germany here.
yeah. Yeah, and the last news of the week, which I have to say was a little bit unexpected, and I don't know if you're happy or not happy, but Alibaba, it is now a dividend-paying company.
I mean, I must tell you, when I bought Alibaba at $150, I had this strategic foresight that they would issue a dividend once. I was doubting, will be Meta, Google, or Alibaba? And yeah, it was worth it. I took the ride from $150 to $80 now
Yeah,
because I wanted to get this dividend.
1% yield. I mean,
Yes, exactly, exactly. 0.5% yield on cost. Hey, but only way is up.
the only way
They
is up.
they have not committed yet towards a growing dividend, but it's a no-brainer. In 25 years from now, this will be a dividend aristocrat. It's just like, I mean, it's Alibaba. It's not like Alibaba and the 40 bandits, or what is it?
Yeah,
So they will not come steal my money, although they did half of it, and then they give me like a dividend in return from their, I said, from the treasuries.
yeah. But what do you think overall? Do you think it's a good move from these guys
Well, when do you pay a dividend? When you
when there's
think
no
that
growth?
well, not so
Not
much
no
growth.
growth, but yeah,
If you
innovation.
have cash left and you can't get a proper return with it, you give it back to your shareholder. Me in this case, I say, like, f off with this money, find yourself a better return elsewhere.
Yeah,
Yeah, so that's why they pay one, and it's cash flow rich. They've been buying back shares again, so this stock is just hammered, low P, starts to pay a dividend. I think they're really trying to, how is it, please the shareholders, I guess, in a different way of return, because in the past it was all around growth, and I think they're
yeah,
now at the stage that they need shareholders, because those managers also want to get their bonuses. And
yeah.
if every year your EPS is going up but your share price is going down, nobody wants to pay you a salary or let's say a bonus. So
Yeah. Yeah, with all the uncertainty around China and China going through its own sort of economic downturn, it's to me honestly it was a surprise they've done it now. As you said, they've been crucified in share price, but maybe they know the power of the dividend growth community, and they know we might start lumping in and drive that share price up and give them that fat bonus.
yeah, rumor says it that Jack Ma is a really big fan of the Dividend Talk podcast. So Jack, if you're listening, we're happy with the dividend. Thank you. I don't know what thank you is in Chinese, but just imagine us saying it.
Perfecto. Let's move on to some dividend hikes. We have a couple of notable ones. We mentioned Siemens with a nearly 11% hike from 425 to 470. DCC, the Irish company, hikes their dividend 5% to 63
And the share
pence.
price popped, right? Also, so when they reported the earnings, I think that it's now in my portfolio 15% up or something like that
Wow.
DCC, and it's such a boring business. I mean, just reading the annual report makes you almost fall asleep. Yeah, but yeah, it was heavily overvalued. Price popped up literally on this. I mean, of course, heavily influenced due to energy. So I'm glad that they didn't hike the dividend too aggressively, just 5%, so that they really can continue the dividend growth streak. I believe 29 years now or something like that.
Yeah.
So
And,
I'm a happy shareholder here, and they can also pop down right one time, but I do believe that the fundamentals are in a good shape here.
yeah. Nike, ticker symbol NKE, a 9% hike for them this quarter from
Yeah,
what was it, 34 cent up to 37 cent.
I'm not surprised. I'm really not surprised, and even this brand is impressing me even more lately because my son is an early teenager. All those kids want Jordans, the Jordan shoes, the Jordan trouser, the Jordan T-shirt. I mean, I think Michael Jordan by itself and the brand is worth I don't know, an S&P 500 company. Amazing. I don't
Yeah.
know. You have also son, right? Is he also a fan of Jordans?
Not so much Jordans, but he does have Nike trainers that he uses. But in terms of football boots, they love the Nike. It's Nike
Yeah,
Mercurials, I think they love.
yeah.
So Nike is very, and even me, I go around and when I'm a football dad,
Yeah.
everything I seem to wear is Nike. It's
And
just
this used to be Adidas in the 90s and the early 2000s, right? Also on the
yeah,
football pitches. It
yeah.
used to be Adidas, Copa Mondial, these kinds of
I
shoes.
I was Adidas Predators.
Yeah, me too. Me
Yeah,
too. But now it's Nikes.
yeah,
I'm also still all football shoes almost Nikes nowadays. So I don't know why it is, but I find them better than Adidas lately.
yeah,
Just more technology in there.
yeah. Which is strange when we're advocating for European and German companies and we're going over to the US to Nike.
Yeah,
But
the football itself, Adidas is still like the most.
yeah.
Yeah, the round one.
And then the last company we have here is Brown Forman Corporation, ticker symbol BFB, 40 consecutive years of dividend increases, and they've hiked it by 6%. And honestly,
Nice.
it's a company I'm not overly familiar with, but 40 years is quite a record.
Exactly.
So the main topic this week is all about bonds. James Bond 007. But honestly, should we own bonds? I suppose you came up with the topic, and I will give you the pleasure of the
Well,
reason behind
it's
it. You know?
really simple because this is not bond talk, this is dividend talk, right? But we got over the last few weeks several times this question like, hey, with the yields of the treasuries at 5%, is now not the time to buy some bonds? And we touched on it briefly in the show then, but I thought, like, you know what? Bonds are a really important consideration if you really think about asset allocation of your wealth and your investments. So I thought, like, you know what, we should really spend some time in sharing our knowledge around bonds and also say, like, in general, how we look at it. Here, I think for most people, it's already a little bit known, but maybe also there will be a bit of a surprise when we share our thoughts here. But then also, like, if for instance treasury yields or bonds are now, let's say, I think treasury yield is now yielding 4.4%. So why invest in Johnson & Johnson for 3% then, right? That's also the question we often get. So let's start talking a little bit about bonds, and maybe you can introduce a little bit, like, just generally, like, what is a bond? Let's
Yeah,
start in
yeah,
simple layman terms.
yeah. I mean, first of all, before I get into that, I think it's a fair question when you look at the treasury yields, and you then look at a company like Johnson Johnson. It's a fair question. Why would you invest in Johnson Johnson over bonds? So I can understand why we're talking about this today. But if we go back to bonds, let's bring it back to the real basics and what is a bond? And in layman's terms, a bond is basically an IOU that an investor gives to a borrower.
What is an IOU?
Uh,
An
I
IOU?
Yeah, I owe you.
Good.
So it's
Good.
that's something like I have to give you something
Yeah.
because you paid me. But basically, you're giving money typically to a government or a corporation, and they're going to use that money to do whatever they have to. So if it's a government, they might use it to build roads and schools and
Yeah.
public transport, or take out loans and so on. And corporations will use that money to maybe reinvest in their business,
And
or
this
if
is when we say that a company issues debt. Yeah,
yes,
that's when we're
exactly.
talking about
Yeah,
bonds, and
yeah,
that's where those credit ratings comes in.
exactly. And
Yeah.
we're giving that money, but we don't give them that money for free. We give
Yeah.
them for what's called interest payments, which is basically money, sort of like dividends in some sort of frequency. So it could be yearly, monthly, quarterly, similar to dividends. So
Yeah. And they
depending
call
on
those officially a coupon, I believe,
coupons.
right?
Yeah, yeah.
Yeah.
Officially, they're coupons. So yeah, that's pretty much it in a nutshell. You're giving money to some sort of entity, whether it's corporation or government, and they're going to take that loan that you give them and use that for whatever, and then pay you coupons in a regular interval to
Yeah.
what would you say, compensate you for your loan.
Yeah.
So,
And then, I guess what's then really important for listeners to know is that there's difference between a coupon and the yield of a bond. So let's imagine, and I think they trade often in thousands, right? So if you
yep,
want to buy a bond, often you need to pay, let's say, thousand, whatever it is, euro, pound, dollar. Yeah. So what happens here is like if you buy let's say a bond with a 5% coupon rate, yeah, five euro coupon on a 50 euro coupon on 1,000, let's say like that, which is 5%. Yeah, you will get this 5% each year as long as the duration of the bond is. Let's say you buy a bond with a duration for 2 or 3 years. Let's say 3 years, you get 150 euros in total, 3 times 50, and at the end of the period, you get your entire 1,000 euro back. Yeah, your principal, and you can reinvest that 1,000 euro then again
yeah,
for the
yeah,
next bonds you want to buy. However, this is not the same as when we talk about yield, the bond yield, because what can happen and what happens is the bond price fluctuates. Yeah. So if, for instance, the interest or inflation is higher and the interest rates are changing, this influences the bond price. So what can happen is actually that your bond starts, I don't know, trading at 95 or 90 or something like that, or the other way around, 110 or
yeah,
120. And what you then need to do is you need to look at this 50 euro and divide it, for instance, by 950 euro if it's trading at that price. And suddenly, I don't know by heart, but you might be talking about 7 or 8% yield. And this really important to know for investors, because it's not just the interest coupon that you're interested in, it's also the price where you're buying it at. And this is where also maybe if we look at already one of the risks here, right, when buying bonds, there's a lot of money to be lost in a bond. If you buy and then specifically if you don't want to hold them for the whole duration.
yeah,
So I believe it's the Austria bond. If you want to hold it for 100 years or something like that, what they issued, and you bought that's like 5 years ago, the price went really a lot down because it was first at a zero interest environment, zero interest rate environment. Let's say it was almost at 1,000. But if we are now in a rate environment where it's like 5% is the expectation of the market, or 4%, and that over 100 years, maybe like let's say 90 years left, it can go, well, not to zero, but very, very, very low at that time. And then you still need to hold this bond 100 years.
yeah,
Yeah, to get your principal back and the dividend size, the coupon payments over that time. So it isn't to say that I said investing in bonds comes without risk of capital loss. To the contrary.
yeah. It's not free money. Nothing.
Oh
It's not.
no,
Nothing is free money. And
no.
I think maybe sometimes that's might be a little bit of a misconception, but you're completely right. When you're holding it for a long time, you can quite quickly lose a lot of money, and it's hard to hold a bond when it drops so much for the full duration, particularly if you're looking at a big time span like 20, 30 years. But maybe you might talk, because there's different types of bonds, isn't there? There's not just one type of bond.
Yeah, and this makes investing for bonds for me really difficult. So you have, for instance, zero coupon bonds. So they only promise to pay specific single cash at a specified maturity. So that's purely capital gain that you're investing in. Then you've got the fixed rate bond. So this regular stable payment, like 5%. You've got a floating rate bond where the periodic payment is actually variable. For instance, can be connected to the Euribor here in Europe. So this rate is established by, I guess, I don't know, the European financial institution, and it can be even a mix of that. But then we even have like mortgage-backed securities, catastrophe bonds, covered bonds, convertible bonds. I mean, there's a whole range of this, and if you want to invest in bonds, I think it deserves some attention to know. For instance, you might take a convertible bond, because that means that you can, how you say it, turn that bond into shares. I think you have also the unsecured, and then the secured. That means like, if it totally, I'm not 100% sure if I'm saying it right in English. English is still not my mother tongue, but it comes down to it. In some cases, if you buy a certain bond, you might have, after the bank, the second right on getting a claim on the assets. As such, and others nothing at all. So it's purely in good faith of management whether they will pay it back or not. So all these kinds of things are things to consider, I would say, when you're investing. In the end, it's your money. You don't want to lose your money. That's usually when we talk about, most people, when they talk about risk, they talk about, I don't want to lose my money. But nobody wants to lose their money. So there's something different than volatility and risk, right?
It does make it quite difficult starting out in bonds. As you mentioned, there's at least 4 or 5, 6 different options that you can have, and where do you start? But typically, I would imagine, and you mentioned Austria, but if you're thinking about it, government bonds is probably, I don't know if I want to use the word safest, but it's probably the easiest to understand, and probably one of the best places to go. We had this whole thing in Ireland years ago when Ireland were bailing out banks and so on. So corporate bonds are another ones, I would think. So government and corporate bonds are probably the two I would stick with if I was going in there, because I would view them as easier to understand, one, rather than say something like a mortgage-backed bond, which to me sounds like an absolute headache.
I think that's really for specialists, I would say. And what's also good to know is some bonds are just not accessible by the retail investors. You might need 100,000 or more, something like that, to even be able to participate. So I think this is a lot for pension funds and such that really need to have the proper asset allocation in place. But for the retail investor, it's a different story. But maybe then a question like, where can you buy bonds?
So I know you can buy bonds on DeGiro, for example. So you can definitely buy some corporate bonds and government bonds on there. I'm not sure about interactive brokers. I haven't checked. I haven't checked that. But DeGiro, 100%, you can buy some. So I would imagine most brokers now have options to buy them.
And then what's probably also good to say is you can buy things via an ETF as well. I wouldn't personally really do it via an ETF, because I think you got even more interest rate risk there. And it's not like an ETF, per my understanding, just pays out the principal at the end. So you're really there in for the coupon rate. But you can also just buy them directly from the US government, right? So they have a program, and you can just go to their website and buy them.
We can buy Irish ones over here in what's called a post office. I don't know if you have something similar, but you can go down to the post office and buy these bonds. And lots of people actually quite do, because they see they're safe to get their money back, and then they get a few extra bob into their account every month. But yeah, we can buy them physically in person here. So
Yeah.
but
So we have to address really a bit more the risks, I would say, for the bonds. So because look, I mentioned already about the price, right? That can go up and down quite significantly, and you would be surprised. They sometimes trade as wild as stocks, yeah, because it's heavily involved by the interest rate risk. In changing interest rates will typically lose, for instance, the bond value. So, in simple terms, when the interest rates go up, bond prices go down. When the interest rates go down, bond prices go up. So, if you think that the interest rates that we are now seeing from the US government, let's say 4.4%, is at the top, and you think we get back to zero interest rates again, or 1 or 2%, and then this might be a great time to earn money. But that comes to the second risk, because that's the duration risk. You can speculate on this if you
yes,
take long-term bonds with a long duration. Yeah, if you buy a bond which is maturing, let's say in a year from now, yeah, then don't expect too much, right? If it is like a 3% coupon rate, it's
yeah,
4.4. You pay probably 98.60 or something like that, and that's it. And if it goes up, you win $1. Yeah, but if it's like 30 years out, yeah, you can make a lot of money by changing interest rates. So sounds sexy sometimes as growth investors or speculators, right? Um, but you have also, default risk. Yeah,
yeah, of
company
course.
can just go down. That's I guess the coupon rate they pay for it.
Yeah,
But another one is very, very important, I think, and this also comes down to my issue later: currency risk. If you buy, let's say, treasuries, U.S. treasuries now at 1.09 US dollar for euro, right? Currency. A week ago it was 1.06. That's 3% almost different already. So in this case, when it went from 106 to 109, then I believe the value goes down. Yeah, but it can also go the other way. So you can lose a lot of money on this. So what do professional investors do? They buy insurance, and the insurance to hedge the currency typically could be between 1 and 2%, depending on the volatility and the
yeah,
market. So if you then have a 4.4% US Treasury bond, and you would insure it also for 1.5%, you still have 3%. So the simple rule of thumb is always buy bonds in your own currency. So if you can buy, for instance, a bond for 3% with the same, let's say, maturity and duration compared to 4.4% of the US one, so Dutch via US, let's say, yeah, then go for the Dutch one, because you don't need to buy insurance on your currency risk, and you should be fine. Now, you can argue like, hey, eDGI and Derek, why do you now mention currency risk compared to when
yes,
you're investing in dividend stocks? When I'm investing in dividend stocks, diversification plays a role in my portfolio, but we have growth behind it, dividend growth, and all these kinds of aspects. You don't have that with a bond. Yeah, with your bond, the only thing you get is your coupon rate and your principal. And we get more. We get growing dividends. We have companies that grow their earnings. So there's generally capital appreciation. There is only capital appreciation, what I mentioned, on a bond because of the interest rate. Yeah, not because the fundamentals of the bond are changing or something like
yeah,
that.
yeah,
So currency just becomes a way bigger factor when investing in bonds. So advice is always to be in your own currency investing. You can try, but to go for US, but you're kind of speculating then also in the currency. But it means for me, in a zloty or dominated country, or I live in the zloty country. Yeah, for
Ye-
me, I would have the risk with euro bonds again.
yeah, yeah. You'll be quite more limited than me, because I'm a euro based. So there's
Yeah,
plenty more bonds that we could buy. But it's funny how stark the contrast is between bonds, what we're talking about, the risks in bonds are compared to dividend stocks. Because when we talk about dividend growth stocks, and we're asked about macroeconomics all the time. And we did a show about macroeconomics as well. And two of us basically at the end of it said, yeah, factors are there, but we don't really pay attention to them.
Yeah.
With bonds, you need to pay attention to them.
Yeah.
They're
Yeah,
at the
yeah.
core of everything you do. And sometimes you feel that's what's happening with investors. They're using similar styles for different types of asset classes, and it spills over. But definitely with bonds, you need to look at the currency. You need to be looking at is there war happening here. You need to be looking at what's happening.
Yeah.
What can influence interest rates? What can influence your currency dropping, and what can influence inflation? So it's definitely, I would say, more hands-on if you want to manage a bond portfolio compared
Yeah.
to our strategy. But it's not all bad. Look, we mentioned some risk, but obviously there's some good points about bonds. And probably one of the most commonly said ones is you've got stable, predictable income. And I suppose, look, as dividend growth investors, that's exactly what we want, isn't it? We do want stable, predictable income. It's not quite exciting. You mentioned you get 5% every year, so you know for the duration pretty much what you're going to get in terms of return, but it is stable. And coming up, see, it doesn't make much sense at the moment, but coming up to retirement, I can see why this would be more appealing to people, because you can kind of count on the return you're going to get. With dividend income, it can be cut at any time at the discretion of a company.
Yes, that's entirely true. And stable again when you have short-term duration, right, in bonds. Yeah, and generally also bonds, they just let you sleep generally better at night because they're not so volatile. We just spoke about the benefits of buying dividend stocks because they grow, for instance, in earnings. But if they don't grow, then it goes the other way around, right? And I was a bit just laughing with a toothache about Alibaba. But yeah, I'm half 50% in the minus or something like that, and it won't recover. At least with a bond, you get your principal back. Yeah. So also the interest rates on bonds, they tend to be a bit higher than the saving rates at banks or when you think about term deposits. So that's also a benefit of bonds. And generally, bonds typically also give you kind of discussion during a recession. Yeah, so when all the stock market is declining and interest rates falls and such, usually the bond price gives you this hedge in your portfolio. Yeah, because what would need to happen if there's a recession, then Fed Powell and Lagarde, they will start cutting interest rates. Well, we just saw the impact of it, right? So if interest rates go down, bond prices go up. Yeah, so they give you this hedge in your portfolio at the same time as well.
Yeah.
And then this brings me also a little bit to what we really have to discuss. This is asset allocation, right? So if we answer ourselves, should we own bonds? Then I think it comes to also the wider asset allocation. And I think there are two rules of thumb that you can look at. One of the most popular one is the 60-40 rule. So you know, and it has been considered for very long profitable, which is like take 60% in stocks and 40% in bonds. So the bonds give you this resistance in drawdowns when the stock market is going down. So this is a very popular portfolio allocation example. And the other one is the size by age. So think about, for instance, the proportion of stocks in your portfolio is generally defined by 100 minus the age of the investor. So if you're a young listener here and you're like 20 years old, you should have, for instance, 80% in stocks and 20% in bonds. If you're a little bit older, 70, it should be the way around, 30% in stocks and 70% in bonds. I like this rule of thumb, but I'm not applying it.
Yeah. Of the two examples there, I think I prefer the one by age as well. I think it makes the most sense. The younger you are, the more risk you should be willing to take, because the longer you have to make money.
Exactly.
In my opinion, so it makes sense. I might not necessarily agree that when I get to 70 or whatever 60 that I have more in bonds, because I still feel like I will always have more in the stock market, but it could be closer to a 50-50 split at that stage. I don't know, but for me, it makes more sense. Definitely portfolios.
It's also all about your risk tolerance.
Of course,
Yeah.
yeah.
How much do you want to lose of your principal? Do you want your kids to have certainty to inherit a certain amount of wealth? Yeah, then you probably want to better do it in bonds. On the other end, if you see risk as volatility, yeah, then you should be better in stocks, fully in stocks.
Yeah, but then you have to look at the timing of it as well. So it made no sense for me 5 years ago for anyone
No,
to be buying
no,
bonds.
exactly.
Let's be honest. Go back to your simple rule of thumb up there. Interest rates go up, bond prices go down. Interest rates are at 0%. There's only one way bond prices could go.
Exactly.
So
Exactly.
it made no sense. So I can see. I think rules of thumb are nice and having 60-40 is nice, but you have to look at the wider picture and think, okay, does it make sense for me to own them now? No. Okay, let's move on. So I think that has to play a part in it. But one topic we didn't touch on, which is always interesting, is the topic of taxation, and how would a tax compare to, say, dividend stocks?
Yeah, well, actually, this is taxation on coupons, right? On the interest payment.
Yeah.
Generally speaking, I said there's a tax on interest. Now, I don't know what it is for each country. In Poland, it's the same as tax on dividends and tax on capital gains. It's all 90%. But in some countries, this might be different. Some countries, actually, tax on interest might be lower. But also, for instance, taxation on capital gains. So if you sell it before the maturity of the bond, then it may be that your capital gain is, for instance, taxed with 15%. Yeah, depending on the country where you live in. And if you hold it to maturity, you might not need to pay tax. So you need to take these kinds of things in consideration, depending on the country that you live in. What is important, generally, coupon taxation is not paid at source. Yeah, this is different than with dividends. So you pay it in your country. I guess that's probably the most one. There may be some government bonds that are also tax-free here. But I think this is also really where it makes it so complex for me, bonds. We spoke already about the type of and amount of bonds. We spoke about the currency risk. We spoke about how to buy bonds. Yeah. So for me, it almost becomes already an investment profession or style on its own way. You need to study everything, almost like what we are doing with stock picking.
Yeah.
If you're going in the bonds, I think you also always need to do your due diligence here, and also you can't borrow conviction when it comes to bonds.
Yeah, and tax is a pretty big one to consider, I believe. And look, I don't know about Europe, but I know in Ireland, for example, we've got
that's also Europe. The last time I checked,
yeah,
but did you float away so far that it's now becoming Latin America?
We're on the coattails of Brexit, and we're hanging on to the UK. But we have, so bonds is taxed similarly to dividends in terms of income tax. So the interest or coupons you get are taxed at your nominal rate, which is the same as dividends. Capital gains is also taxed the same, so that's 33%. But what bonds actually have, or some bonds, not all bonds, they have this what's called a DIRT tax, DIRT, which is a deposit interest rate tax, and that's also charged at 33% on some of your savings. So that's an additional tax that you have to pay. Some bonds have an exit tax that you have to pay. And then, like you said, there is government bonds that offer incentives for you to buy it. And generally what those incentives are is that you don't pay DIRT tax, which is an additional tax you don't pay when you're a dividend growth investor. So, I mean, it's tough. It's definitely a lot more complex, I feel, than investing in stocks in terms of.
So no, by the way, before I ask you the question, guys, you hear us already talking. We don't know about your countries. We're not so knowledgeable about that, like when it comes to dividend taxation. So please, really, get in touch with a tax advisor before you hit the buy button on the bond. Yeah,
Yeah,
I know we are not the biggest fan of disclaimers and such, because we feel like we have smart people that listen to us. They can do their own work, and we try to share our knowledge for their benefit. But in this case, really, guys, check with a tax advisor, because you don't want to be screwed in the end of the year.
yeah, yeah. But I suppose the question you're going to ask me is,
Yeah,
do I want to own bonds?
yeah, exactly.
Um, and you know what? Right now, the answer would be no, not in this moment, and I'll tell you why. I classify myself as a dividend growth investor, but emphasis is on growth. That's the key
Hmm.
word. That's the one you need to put in
Yeah,
caps. And I feel you don't get that from bonds. With dividend growth investing, and with my age, I'm still under 40, just about. I'm,
yeah,
I'm getting there, but I still feel like I'm young enough that I can still take those risks in the stock market. I don't need that steady income right now. I'm not retired. I'm not relying on that income. So I'm pretty much focusing on that growth phase. We call it the accumulation phase, and I don't see bonds as part of that. As I approach retirement, whether it's financially free retirement or maybe it's from my job by the time I get to 60 or 70, they might play a little bit of a part in my portfolio. But certainly for the moment, I'm definitely more focused on growth and growing my portfolio rather than stabilizing it at the moment.
yeah. Well, plus one, I have kind of the same philosophy here. I also find bonds riskier than stocks, and it's not because of, let's say, the volatility behind it, but just my knowledge. I've built so much knowledge around dividend growth investing that I feel I feel kind of confident that my portfolio will grow when I zoom out over 10 years. And my portfolio is also designed like that I don't need to sell my portfolio during a recession or parts of my portfolio, because I'm expecting dividend income, and also I will make sure I have a margin there for to be able to carry a few dividend cuts during the worst recession we might ever experience. So from that point of view, I think I have my safety baked in. It does mean, like, from that point of view, that I embrace volatility here, because with bonds you just have it less. But okay, like Peter Lynch says, volatility is my friend. But to your point, if I would be 60, 70, I think I might start looking different at that. Now, where I wanna maybe do a little bit with bonds, because what I'm now doing, I have cash on my account, on my savings account, because I'm saving up for a car, right? My car is a certain age, and I think in 3, 4 years from now, I need to buy a new car. Well, you've seen the car prices; they are not cheap. So, what I'm thinking of, instead of putting it in term deposits, what I'm doing now, maybe I will start exploring: can I put some money in a bond for a year, let's say with a maturity of a year or 18 months, and just start to experience really how easy it is for me to buy bonds via the brokers and such
Yeah,
here, just to gain some experience, and take matter in my own hands.
yeah, and relatively low risk over a shorter time period, I would imagine. So very, very good. Look, as European DJI said, that's our thoughts on bonds. We're by no means experts in this subject, so please go see a tax advisor if you need any help on this subject. But always a fun and interesting topic, and sometimes it's nice to talk about something other than dividends to give us an appreciation for dividends in general. And with that, we might move on to some listeners' questions. And we'll start with the first one, which is from Baz. And I'm guessing this is for you, European DJI. And he's asking, do you continue and are you a stickler for the rule of not buying anything below a yield of 2.75?
90% of the times, yes, with exceptions. My exception that I made the other time is I bought Evolution Gaming, which was yielding at 2%, because I expect really large growth there. But otherwise, it really just doesn't make sense for me. Yeah,
Yeah,
that's the thing. It doesn't make sense for me if you think about, uh, I mean, imagine buying Apple now at 0.6%. They're growing the dividend by 10% per year. I mean, it will take 40 years for it to hit 10%
Yeah,
or something like that, or 30 years. It doesn't contribute to my portfolio right now. Of course, I have a lot of Apple in my portfolio, but that's because of capital appreciation, nothing else. So, Bas, yeah, generally yes, but if there is an opportunity like Evolution Gaming, or if suddenly Visa will trade at 2.5%, I will buy Visa, yeah, because they've been able to grow the dividends by 15 or 16% each year. But for most stocks that are in my passing my stock screener, it makes no sense.
yeah. It's an easy rule to stick to right now, because everything there's lots of actually really good companies that are above that. Maybe it's not so easy when you ask when we're at the height of a bubble and everything is trading at
I've
all-time
been
highs.
doing that. I've been
Yeah,
doing it at the 2021 top of the bubble as well. There are always some stocks or a sector that is out of favor.
yeah.
So um, I've not had ever the issue not able to find a stock at all to buy.
Nice. Neil has asked us about what sectors would we look at in the current market, other than real estate investment trusts and financials, which we all know are pretty depressed at the moment.
Yeah, for me, consumer staples have been cooling down. Ahold, 26 euros and change. Target, well, they popped up after their earnings this week by 90%, but still in a relatively attractive price. So I would say some of those consumer staples are interesting again for me. I expect actually that it becomes a little bit even worse because I still think like the consumer is tied in their wallet. So let's see how that develops. But
Yeah.
consumer staples, yeah,
Yeah, consumer staples is kind of going under the radar a little bit. Anything but technology, I suppose, is probably suffering some bit at the moment. And one other
yeah,
area I'm looking at is investment trusts, because they are
yeah,
trading at huge discounts to NAV at the moment as well. So I think
yeah,
they're
true.
definitely worth interesting.
And what's interesting, I was in touch with Neil the other day because his son is doing a stock analysis, and he will probably make a guest post on my blog. So this is really
Oh,
exciting, right? That we can help someone's son with gaining experience and
that's
such.
awesome. That's awesome.
Yeah, yeah, yeah.
Do you want to share the stock, or is it a surprise?
Well, I gave three stocks for the person, but I will let the person decide which to choose and make the final article on. So, but I hope in the upcoming few weeks you will see an article popping up, and it will be his first article ever.
Yeah,
So let's see. I'm
that's
coaching him a bit, helping a bit with what to look at, and let's see how that goes.
awesome. Awesome. Well done to Neil and to your son, and obviously to you for giving your time as
Yeah,
well.
I wish that I first of all, I wish that, that I was interested in finance at that
Yeah,
age, and I wish that I had a father that connected me with some people
yeah,
in this space to learn and to be able to get public with that. So
yeah. Awesome. I look forward to that article. Philippe has asked us. He's a beginner investor, and he's asking, where do you search for and screen stocks and companies for a further deep dive? Obviously, there's plenty of tools and pages for US markets, but for us lonely Europeans over there, where do we go?
well, that makes it a bit harder. So you will have a few websites there. Philip, what I will do just in the description of this podcast, look at the link to a stock screener article that I have on the blog. You will see there I try to address this topic as well. I think a website like MarketBeat allows you to screen a little bit, but the issue is that typically the dividend yields are not reliable. So, as you may know by now, we started our newsletter. It gives access to a beta dashboard as well. We included there a bit of a screener. It's, of course, limited to the dividend growth stocks that we put in there. So it has about, what is it, 80 European dividend growth stocks.
Yeah, around that.
Yeah, it will grow over time. But, if you think about public free available, it's really hard, Philip, because also what comes to the screener you can't necessarily trust. And what also means is that you might have companies that are getting filtered out because of some incorrect settings, which is also a pity. So you still don't get the right stocks on your radar.
Yeah, yeah. It is tough, and it's particularly hard when you are looking for European companies. Because if you search for US companies, there's lots of different blogs and articles. But let's say you want to find companies in Holland. Most of the articles will be in Dutch, and do you know what? So you have to rely on Google translating, and Google's clever enough to know, hey, you don't speak Dutch, so it's not even going to give you the give you the articles in the Netherlands, for example. So it is quite difficult. You have to rely a lot, I think, on community members. We get a lot of stocks thrown at us. I wouldn't know half of them only for doing the podcast and the blog. So I can feel your pain. But yeah, like you said, we're going to try our best to build that specifically for Europeans, because I feel that's what we're missing. But it's a lot of manual work, as you can imagine. So it's a work in progress for us. But Finviz is another one I find quite interesting as well for European companies. Marcian has asked us, if you have two companies being in some kind of duopoly, operating in the same sector, similar to one another, what would you do? Would you buy both, or would you make the best case you can to pick one and stick with it?
There are sometimes cases to buy both and sometimes not. I would still look at the quality of the business. For instance, AT&T versus Verizon. Yeah. If you looked at the balance sheets and management performance, Verizon would have been probably a better case with the knowledge we have today. But if I think about Visa and MasterCard, I would generally always go for the best. Always go for the best. But in other cases, like, you can buy Pepsi and Coca-Cola. Yeah. So it really depends case on case. Like in a duopoly, there can be two companies that both have an excellent balance sheet, excellent track record, and they keep each other in check. Buy them both. Can also be that one is just really pristine balance sheet and the other one not. Yeah.
Yeah, I have to agree with you. You can make a case for either. I think the better you understand the market that they're in, the easier it will be for you to pick one and understand which one is generally better. If it's not obvious when you're looking at the financials, it's not popping out. If you understand the market, it's easier. But if you don't, say, for example, Visa and MasterCard, I would not see any issue in that. But then you're forgetting about American Express, which is in there as well. So it's not quite
but even being in a monopoly or a duopoly, it doesn't protect you from stupid management.
No,
I mean, look at what AT&T has been doing. What an idiots! What an idiots! It's unbelievable. And they are kind of in duopoly. I mean, they have also T-Mobile US and such right there, which was a competitor. Because that's also one of the issues with duopolies. There are limited incentives for management to give their utmost best because there's limited competition. Yeah, so management might be even more full of shite. Sorry for my language, of themselves, and just ruin the business into the ground.
Yeah. I agree, and you probably shouldn't let the fact that it's a duopoly make you lazy and not look at both companies, because, as you said, management can hurt a company quicker than anything else.
And Derek, the guy is called Marcin.
Give me a break. I do my best to pronounce these names. I mean, we've got simple names over here now. I don't know how to pronounce half the alphabet and stuff over there. So I apologize. I think I've done this 100 times already with names. I really do my best. So please accept my apologies for my poor pronunciation. So the next one is a nice, easy name. It's Tim. And Tim's a regular listener and obviously a moderator for us over on Facebook. But he's asked us a question about diversification or valuation. When you're in the accumulation phase, which one would you prioritize? Valuation.
Yeah, I mean, come on. Look, really simple. If you start, you buy your first stock, you will not be diversified. You've got 100% single stock risk. Then you buy a second stock. Then you buy a first stock. So it makes not a lot of sense in your first 1 or 2 or 3 years even. Yeah. For me now, after 9 years of investing, if I would be still putting everything in energy stocks, too much wealth at risk. But you have no choice in your first year, really. I mean, what sense does it make to buy 20 different stocks at the same time? Then buy an ETF.
it also depends on how much money relatively you're applying. If you're going to put a couple of 100K into the market, you probably might want to diversify. But if you're like most investors
Yeah,
that
true,
we
true,
know and we
true.
talk to that are doing this out of their paychecks month to month, year to year,
Yeah,
then definitely I think valuation comes into play.
yeah, you're 100% right. Yeah.
Killian, another nice Irish name. See, I can do the Irish names. He's asked us about UK financial stocks. We've mentioned lots in the past, and he's asked us about Aviva. It's an insurance company. I'm not sure if you know them. They're quite popular over here in the UK and Ireland. Honestly, I know that they pay a nice, hefty dividend yield, but I haven't looked into them. I haven't felt the need that I have to. I have a couple of insurance stocks in my company, and I don't really want to add any more. But by all accounts, I know that they are a good European dividend paying, UK dividend paying company. Should I say? And it's quite well regarded over there. But I haven't generally looked at them um, in terms of owning them myself. I do have insurance from them. Full disclaimer: my car insurance is with Aviva, so I'm familiar with their products. But no, I haven't haven't looked into them completely to give you a full and honest answer on that. So apologies.
Yeah.
And Gustav has asked us if you had a spare room in your house dedicated for your dividend stocks hobby, what would it look like?
Well, a little bit like my room that I am in now.
I was thinking the
Uh,
same.
Big
Both of
white
us.
screen on my desk for the podcast. A second screen for reading the annual reports, and a filing cabinet here with some old annual reports that I had. But I would want to have everything digital nowadays. Brandon van der Zee, if he's listening, thank you, because I've got 4 Berkshire Hathaway ducks here. I've got the book from, and I see it also with you lying there, from Charlie Munger, the almanac.
Yes,
So
yes.
that's how it would be decorated. I've got the Wall Street investor cheat sheet canvas on my wall as well, with the psychology of the market. So yeah, pretty much like this. But what I'm missing is a TV with some access to CNBC or something like that. But
Yeah,
this is tricky because I don't want to be fooled into market day-to-day price up and down. I want to protect my mind from these kinds of impulses at the same time. So maybe that's why it's not hanging on the wall. But actually, Gustav, I'm living that life. I've got the spare room for myself.
it's so funny you mentioned the TV because yesterday my wife is asking what to get me for Christmas. I'm like, I don't need anything, blah blah blah. And she kept pushing and pushing it, and said, you know what I need is a TV. So over my desk here, I want to put a TV there, not for CNBC. I want to put my portfolio up there that's going to update every day, tell me what dividends is due, what dividends I'm going to get this week. And it's just every time I look up, it'll be there. And then maybe on the side, like a newsreel that'll automatically update for the companies in my portfolio. So when I'm sitting here just relaxing, I have all that information there without having to do it. That's
But you really need to program this sound into it. Like when you get a dividend, like ka-ching,
yeah,
ka-ching.
yeah. Might drive my wife mental, but I might do that because her room is just right on the back of that. But that'd be awesome. Yeah, every time
You
a
could
dividend.
program it, right?
Of course you can. Yeah, you can do anything.
Put it in GitHub so that others can benefit from it
Yeah,
as well.
ka-ching, ka-ching. Be nice. Yeah, but that's
I once asked the hero if they could implement this, right? Like when you get a dividend payment on your phone, that it would give a notification because Trading 212 does it
yeah,
on your phone, but that it
yeah.
would also say then catching based on the dividends. So they said they would suggest it to their app development team, but 2 years later, I haven't seen this feature yet. But I would love it. Imagine you're sitting in the office in such a call with others, and suddenly in the background, ding, and they would say like, "Dan, you're also a dividend growth investor."
They call me the boring dividend growth investor. I'm working out at this stage. That's
Yeah,
actually what someone called me. Yeah,
yeah,
they were talking about there was some in work. They have these it's like a lotto within the workplace, and
yeah.
the winner can win like a 20K prize. And in a meeting, there was about 30 people there and said, I really hope Derek doesn't win it because he'll do something boring, like invested in these boring dividend stocks. And I was like, yeah, you're right.
So the fact that you're building wealth is considered boring. I mean, it says so much about the psychology of the investors, right?
It's brilliant. But hey, they were dead.
Speculation is the way. That's for sure not boring. Yeah.
Um, okay, I think we have a couple more questions we'll try to get through. And Reitz has asked us, he's mainly into dividend growth stocks, and about 30% into growth stocks. So he's a mix of two. Recently, he started selling options to further increase his returns. For now, he just sells covered calls and cash secured puts. His question is, if you're buying shares with limit orders, or you are price anchored anyway, would you not always sell puts at your strike price instead of just placing normal orders? Seems like you're just leaving money on the table, or is he overlooking something in his enthusiasm?
Yes, he's overlooking one simple thing is if you want to buy 100 shares of Microsoft, poof, I don't have that cash lying on the table. The cash that I have lying on the table is typically my monthly savings. So when you think about it, and let's say it's 2K, let's say 2,000, what can you, then you need to look at stocks that are trading for less than 20 euros.
Yeah.
Yeah. So
the other side of it is that if you truly want to own this company, there's no guarantee that it's going to come down to your strike price ever. And I'm going to use Microsoft as the example.
Yeah.
Let's just say you had the 20K to invest. They were trading at 100.
You mean 36K in this
No,
case?
at the time, maybe 2 or 3 years ago,
Okay,
when they were trading at like 180, and you're like, I want to buy these at 170. Or when they were trading at 200, you want to buy them at 180. And you place your strike price at 180. They're never coming back to 180. So you can lose the opportunity to own that
Derek,
company.
I don't know, but I'm not investing 18K at once into a single stock in my portfolio. No, it's not I'm not the market moving wheel.
The money there is irrelevant. I think the theory behind it, whether it's a 20 euro stock or 180 euro stock, it doesn't matter. You can put your puts on, but it might never come back down to that price, and you might lose the opportunity of buying them.
I'm happy that you say the theory.
Yeah.
Yeah, because that's not what practice means. Practice means if I would need to invest now 18K into stock because it gets exercised, I would be on margin for quite a significant one. And then I will be thinking like, yeah, shit, I need to sell this stuff again because I need to start paying interest on this. I don't have the capacity to just figure out 20K somewhere. I would then need to pull from my emergency funds, which they are not supposed for, or I would need to sell other stocks to do it, or sell straight away. But if it gets, for instance, exercised at 180 and it's at that time trading at 170, you make $1,000 loss in this example.
Yeah.
Which is a lot. It can wipe out the entire year of options in one go. So no, it's for me like with limit orders, I don't have this risk of this. So and this I think indeed where enthusiasm kicks in. So I do a bit of option trading on stocks I want to own, but those stocks are never really trading more than 30 or 40 euro, because then it would be like 2 or 3 months savings. I could probably collect it. Also, if I would then sell it, I can take the loss. Then we're talking about 100 or 200 euros lost.
Yeah,
I can easily cover that, but I cannot do it for these stocks that I mean, thinking about buying an Amazon put, or Linde. Have you thought about Linde?
No, not in terms of puts, but
no. So I generally agree with this thinking. Yeah, like if you are very knowledgeable in option trading, and you feel like I want to own them anyway. I have that with a few stocks. It happened to me even in the past that I bought the 100 shares because of that as a result. But I do this on stocks with small share prices because I can't afford it on the larger ones.
Yeah, and it's probably, I mean, again, it depends on how much you want to own that company. If you're willing to wait and take the chance that the share price might never come back to where you want it to, then yes, it's
Okay, but take Microsoft in case again. It's now trading at $360. Let's assume your fair value is $250. You sell a put at $250. You're happy with the return you get on this. Would you want it to be from day zero and then suddenly to the next day to be your largest position in your portfolio entirely? And the fact is, are you then still so convinced about $250? Because it's easy to say at $360 that you want these shares at $250, but then suddenly they're trading at $220.
Yeah.
Because this is what option trading, my experience is, right?
It's not as easy as it sounds. It's tough, and the psychology does play a big part, particularly when you are buying puts, like you said, or selling puts, and the market is dropping. I would say in the last 18 months, it's probably been really difficult to be a put seller. So it's not without risk. I do get it, and it's something we all do. You can buy it, but again, there's always, you're getting a premium, but there's a risk behind that. And like you said, depending on what you're limited to in terms of your budget, you might pick up some premium, but is that going to match or be as more if you put that into some other company like a dividend and actually start receiving dividends straight away? So there's plenty to think about. It's not straightforward, but lots of people do it. It depends on.
Well, I do option trading as well. I sell some puts. I sell a few covered calls. It is to his point. It is on stocks I want to own. It is on stocks that I don't mind selling if it really happens. So I'm selling cash secured. So I'm selling covered calls on ExxonMobil, for instance. Long-time listeners know that I'm not having the best opinion about the company as a whole compared to Shell or Chevron. And it's been doing me really well because I'm selling the call at $110. It's never really touching them around the strike price, but I all the time get like $4 or $5 as an income out of that. So it earned me this year already probably $25 overall, which is a good return on a stock trading this year around $100 all the time.
I just think it was important to highlight some of the risks because we know that 12 months ago, 18 months ago, this was probably the biggest touted cash machine out there, and it seemed like it was easy. And to be honest, it was a little bit easier when the market was going up because you were nearly always going to make money. But particularly in this type of a market, it seems a lot harder. So there's risks involved. I think most of us have done it or still do it, but it's just be careful with options.
Be really careful.
Frugal Cash Flow has asked us, if the yield and fundamentals were right, how low of a market cap would you buy until the liquidity risks outweigh the mispriced opportunity?
I find this hard to say. I own Defama. What is the market cap on Defama at the moment? It must be also like that, effectively. Let me check. Defama market cap.
102 million.
Yeah, 100 million, effectively. And I own Defama. There's limited liquidity there. Tricky one, really tricky one, but I really, really believe in the future prospects of this company. I have no issue owning them. It's not even a mispriced opportunity. I think it's a relatively fairly priced opportunity, but I expect lots of growth there, and I expect the dividend to follow.
It's, I mean, again, it depends on your time frame on owning companies. If you believe in the long-term future of a business and you have no intention of selling them for 5-10 years, it's probably a lot easier to invest in low low cap companies, but I don't really have that many, if any, that I can think of in my portfolio. It's all medium to large cap. I don't have the family, so
Yeah.
I'm not in that bucket.
Well, I've got also Chesnara from the UK, the insurance company. I don't know exactly what their market cap is. Oh, I see a 400 million, and I own Ambra. And what's their market cap? It is probably also something like 125 million, I guess, something like that. So, yeah.
Tiago's asked us about medical equipment companies. Have you looked at any? What do you think of them?
Well, I've been looking at Medtronics the other day, and yeah, they are not a good cash flow machine at the moment. I would say at a certain moment, the risk reward will be in a favor. Yeah, if you can get Medtronic for $1, it's of course something different. It's no brainer. Around $70, probably fairly priced, but not happy with the no growth in cash flow there. And I think this business generally has been struggling. I was surprised by Johnson Johnson. They had, after many, many years, they had like a 8 or 9% growth there in their business. It was mainly due to, in my opinion, favorable pricing power in an inflationary environment.
Okay.
Tough business to be in. Tough business to be in.
Yeah, it's a very tough business. It's a lot of competition. I don't know if
Yeah.
what the margins are like, but I'd imagine they're quite tight.
Yeah, we have Stryker there as
Yeah.
well. But the business is just tough because you're in the healthcare space, so heavily governmental revenue regulated. You need to be. It's all about innovation.
Innovation is just, I was going to say, innovation is the biggest thing, and that, unfortunately, that costs money.
Yeah, but you also need to. That's the issue sometimes with these big companies like Medtronics. Can they be still a serial innovator? Yeah, and didn't they become too corporate? And secondly, at a certain moment, like if you're so big and the market is saturated, first of all, it's really hard for you to innovate. It usually takes an outsider to disrupt the market here, but also the incremental value innovation gives to your portfolio. Then you need to be innovating everything and have the thinking like Steve Jobs, like I'm going to cannibalize my own portfolio because if I don't do it, someone else will do it. But when I look at the medical equipment companies the big blue chip companies, I don't see this attitude there. And then you go to the smaller ones, but then you have a lot of single stock risk, a lot of single product risk.
Yeah.
And I was for a moment, literally for a few months, I was invested in a stock called what was it, Zini or something like that, and they had a small device, very promising, I thought, but actually after 1 or 2 months, I thought like no, and I was investing in it for a growth stock, and I thought like no, okay, no, I don't get this business. This product is too much single product risk for me. I want to be out. So I didn't lose on it at all because I was quick enough realizing I made a mistake here.
Yeah. Okay. And then maybe one last question before we finish up, and that is from Moilos, who has asked us actually 3 questions. The first part of it is Roche. Roche Pharmaceuticals is down 25%. Would you buy the dip? Roche is a Swiss company, great European record in terms of dividend increases, and look, it's probably one of the strongest companies in Europe. Still, for me, it's, as I said, a Swiss company, so the tax is too high. I think it's yielding 4% right now, which is quite high. But effectively, that was probably work out with my tax rate and the Swiss tax on top of it. I'm probably still only getting a 2% yield. So, but yeah, I think if you are investing in someone like Roche, you need to, I think you need to understand their business. And in terms of their pipeline, I'm not a real expert in that, and I do read about them a bit, especially with short dividend, but I struggle with their pipeline. they honestly they list a lot of stuff out, but I don't know if it's going anywhere. So I think to invest in them, to buy the dip, like all pharmaceuticals, some of them it's easier to understand, but you just need to understand the pipeline. I feel in a company like this. The second part of that question is Amler. He says it's a potential dividend gem and free cash flow machine. I don't really know a whole lot about them, do you?
No,
No.
not about Daimler. But again, Daimler Trucks, I really don't like car companies to invest in. Really not, because of the cyclical nature of the business. If there's a global recession or something like that, companies will be tight in cash. They will just not order trucks at that moment in time. That's what history tells us. So no. May look good after 10 years of flourishing growth in the world. We've seen, of course, a bit of COVID, but no, not for me.
And then his last one's around Bayer. I haven't actually looked at them in quite a while. I don't know what's going on with that litigation.
They're at 40 euros now. I'm holding this bag, and you know, this Monsanto is still not solved as such. The new CEO is in. Well, didn't get them up so much initially, a little bit, but I mean, I know I'm talking about share price here, but it's not like they're paying a growing dividend. So, you know, but a decent yield, let's say it like that. It just looks so undervalued, you know. I think Bayer is suffering here from the sum of the parts in their business. I think here, if you would split the company in those, let's say the seeds business, the pharma, and what's the other one? I forgot. But if you would split it, probably you will get, as a shareholder, way more value out of this company.
Yeah, it seems like it's only one decision away from popping, doesn't it?
I believe they are intending even, are they considering even how you say to split? But you know, we saw it with General Electric. Please spin it off. We see it with 3M, with the healthcare business. We see it now with also the trend of I said these pharma companies to sell their consumer businesses. We saw it with GSK. We see it with Johnson Johnson, with Kenvue. So I can't imagine they will not sell a split, because like how it's being operating that like now, maybe it's just too complex. Maybe it's just too complex, this holding structure.
Yeah.
Philips did the same, right? Sold a lot of stuff.
Yeah, so just reading it there, they're examining spinning off the crop sciences or the consumer health. So why not both? But we'll see. As you said, from a share price perspective, it does look undervalued, but Monsanto probably the worst.
It's all about Monsanto here.
That's what's killing
60 billion down the drain.
Yeah. Okay.
Hallelujah. Yeah. Why is this question at the end of the show?
Oh, I don't know.
He always knows that he triggers me with Bayer, and he knows he pisses me off. We are sometimes on the DM in Twitter, and we're kind of making fun with each other. But Bayer is this stock that's like a red flag on me, like IBM. But I still own Bayer, and I think I do this to torture myself.
Yeah, I think it's the ultimate turnaround play. That's what it is. This is the ultimate turnaround play. So
yeah, probably but Bayer Leverkusen is number 1, right? In the Bayer Leverkusen in the German league.
Xabi Alonso, Liverpool legend.
Yeah. So look there. Hey, there's a shining light there.
Yeah. Let's finish on a positive note. I like it. I like what you did there. Listen, thanks a million for all the questions. There is some we couldn't get to. Some of them involved tickers that we weren't quite familiar with, or we didn't want to just give some sort of rubbish
Yeah,
answer.
but
So
we will reply to them still quickly before the show is released, so that they don't need to listen to the show if this is the reason why they want to listen.
yeah, exactly. And thanks again to everyone for listening, and we will see you hopefully all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.